Well, a warm welcome to everyone, and thank you for joining us today. My name's Joel Carty from Solace Financial, which is a locally owned and locally staffed financial planning firm in Brisbane. Today we have Chris Inifer from Alexander Funds. Chris joined Alexander Funds in 2021 as head of distribution. He brings over 30 years of financial service experience. Prior to joining Alexander Funds, Chris' most recent role included head of retail for Alexander Gray Australia. Chris's broad experience and education affords him a unique skill in distribution, which includes a genuine understanding of the underlying investments in organisations he has worked with. Chris holds a degree in economics and finance from RMIT University and a postgraduate diploma in financial planning from RMIT University. But before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through our discussion today, we'll be discussing financial information, which is general in nature, meaning it does not take into account your own objectives, financial situation, or needs. So it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting upon it. Please also refer to any product disclosure statement regarding the financial product for further information. Details of this general advice warning can also be found at the moneysmart.gov.au website. Thanks for joining me today, Chris.
Yeah, pleasure. Great to be here. Thank you for having me.
As a fund manager specialising in fixed interest and credit strategies, can you talk us through Alexander Fund's history and investment philosophy?
Yeah, sure. Look, Alexander's got a really interesting history. We've been in operations in Australia for about 15 years. Our business came about when Chris Black and Rachel Shirley founded the business. And Chris's background is particularly interesting in that he came out of an investment banking background where he ran balance sheet money for investment banks in Canada and also in Singapore before returning to Australia to establish Alexander Funds, initially managing his own money the way he wanted to manage money, and then building that business, starting to look at clients and friends and family and managing their money in a very similar way. So the philosophy stems from his beliefs and the strategies that he learned in running balance sheet money for investment banks. So it's an interesting background. It's one that's quite different when you contrast it with other managers in the country. And that philosophy still runs through the organisation and permeates through our business to this day. So the history is interesting. Chris now runs the business alongside Adam Scully, and they're the joint portfolio managers. So they preside over all decisions that are made at an investment level. And Rachel runs the business and is the chief executive for the business.
Okay. So can you talk us through the investment process you use?
Yeah, so the investment philosophy and process are quite linked. The investment philosophy centers around this idea that we want to generate absolute returns to clients, which in normal person's language just means that we want to generate positive returns or positive nominal returns to clients regardless of the market environment that we're in. And we think that that's ultimately what people want from a fixed income instrument. They're not looking to wake up and realize that they've got a negative return. And we saw some of those challenges for the broader market in 2022 in particular. And as rates or interest rates started to rise rapidly, a lot of traditional fixed income portfolios experienced negative returns. And at Alexander, we were able to continue to deliver positive returns month in, month out through that year. And I think that's what clients ultimately want from us. It's easy to say, it's difficult to do. So to achieve that, we employ both a top-down and bottom-up approach to managing money. When the top-down piece really means that we're having a close look at the macroeconomic factors that are driving fixed income markets around the world. So there are things like broader macroeconomy analysis, looking at political issues, looking at geopolitical risks, and looking at the relationship between GDP and rates and where credit is going. And so lots of different things at a macro level we're looking to consider to set the overall risk parameters of the fund. And then once we've done that, then we have to determine what are the things that we're actually going to buy, what are the securities that we're going to put in the portfolio that our clients will ultimately be invested in. And that's that bottom-up piece.
Sure.
So we employ both of those methods, and we think they both have equal weight. They're both equally valuable. In pursuing an absolute return strategy, we think you have to have a broad palette to paint with. And by that, I mean you can't just silo yourself into a single part of the credit market. You have to have the tools and the expertise to be able to span the credit universe, to be able to identify where the best value is at any given point in time in the cycle. And to be able to do that, you need the experience and the expertise of the investment team that have had exposure and experience with lots of different types of credit instruments, lots of different types of investment securities. And you need the systems and the compliance and trading systems to be able to monitor, and the governance systems to be able to monitor those decisions that you make, and the risk systems to be able to monitor it every day as well. So we think those are the important things. If you don't have that broad palette to paint with, then it's very difficult to deliver on our hope or promise of delivering positive nominal returns. You need to be able to traverse the market and identify the best possible value wherever it happens to be. And the credit markets and the fixed income markets are a disparate group of securities that can operate and be valued at vastly different valuations to one another, depending on where we are at. So it's not as simple as just buying one thing and saying she'll be right. You need to be able to traverse the credit markets and move to different pockets as value starts to emerge.
Sure. So it's pretty impressive during the recent period where interest rates have risen and to still achieve a positive return from fixed interest and credit. But you mentioned risk. So how do you assess risk when making investment decisions?
So we look at risk in probably four broad ways. Firstly, there's credit risk, which is and default risk. So that's the risk that someone doesn't ultimately pay you back. So if I lend you $100, what's the risk that you don't pay me back in the time frame that you promised that you would pay it back?
Right.
And to mitigate that risk, and if we use us as an example, Joel, I'm going to do an enormous amount of work on you individually to determine whether you are capable of paying me back at some stage in the future. So when it comes to that default risk, it's obviously critical, because in fixed income and credit, there's no upside. So if I lend you $100, you're not giving me back 200 in 12 months' time, like a share might, or an equity, or shares in the Commonwealth Bank, or Nvidia, or any of these other stocks that have done incredibly well. So there's no upside. The biggest upside is I get my money back from you. So I need to do an enormous amount of work on you or the entity that I'm lending that $100 to decide whether it's a good idea or a bad idea. Now, along the way, I want to get paid some interest as well. I want to make sure that you can meet your interest obligations throughout that the period of time that I remain committed to lending you my $100. So that's one of the risks that we worry about. We also worry about market risk, and our market risk is the risk that the value of your holdings goes up and down, and to what extent it goes up and down every day based on market attitudes and where the buyers and sellers in markets choose to meet on any given day. And people are very used to that relationship in share markets, not so used to that necessarily in fixed income markets. But much like share markets, there is an over-the-counter market for credit securities where institutional groups meet and they buy and sell securities. And they can buy and sell them at different prices from day to day based on perceptions and attitudes in the market, much like exists in the share market. So we need to be mindful of that, and we need to be mindful of how sensitive our portfolio is to the volatility that might occur in credit markets. So we think about that. Liquidity is obviously something that's near and dear to our heart as a credit and fixed income manager. We need to be able to satisfy a level of liquidity such that if people want their money and want to redeem and use the money for their pension payments or for buying a car or helping to buy a house and they want to redeem, we need to make sure that we can facilitate that and provide them their capital when they need it. So liquidity is quite critical, and there's a significant risk that we monitor on a day-to-day basis and fundamental to the management of the fund. The fourth risk is probably ESG.
Okay.
And when we look at ESG in a variety of ways, probably three core ways. We have some dedicated exclusions in our portfolio. So things like tobacco, for example, is excluded from our portfolios. We have some limitations and constraints in other sectors, such as mining and gaming, and alcohol. And then and the things that we do own, we have a significant ESG overlay on the things that we buy. So it's integrated into the research process with those particular holdings. And if we felt there were some concerns for any particular reason with a holding, then that may impact the valuation that we attribute to a particular security, and then in turn may impact to what extent we can buy it or not buy it. So they're the four broad risks that we think about in managing the portfolio on a day-to-day basis.
Okay. So what are the opportunities and risks you see in the credit and fixed interest market at the moment?
Look, we've been through an environment over the last 8 to 10 months where risk assets have done incredibly well, both shares and credit. And as a result of that, you've got this notion where spreads have come in a lot in credit market, which means that those that are wanting to borrow money can borrow money at a cheaper rate than they have for a long, long period of time for the risk that it represents. So for us, that means that we have some concerns about whether the valuations are attractive enough in credit markets. Now, there's certain pockets that are attractive. And one area in particular is a certain type of security where we are providing capital or lending money essentially to the non-bank financial sector in special purpose trusts or warehouses called special purpose trusts called warehouses. And we think that that's a really attractive space and has some unique characteristics about it, which means that we can get paid quite well for the risk that we're taking. But in the public markets, there haven't been that many things that are really attractive over the last sort of 8 to 10 months. And if you combine that with the sort of macroeconomic factors that have occurred, particularly a rising rate environment and the ongoing impacts that is having on certain cohorts of the consumer in Australia, retirees are really enjoying it because they're getting paid quite a lot on their term deposits and income producing assets. But people that are younger, that are in their 30s and 40s, that are trying to save for mortgages or save to buy houses, the service sector, they're under quite a lot of pressure. So you sort of have this two-speed economy in terms of consumers at this point in time. And we have some concerns about where it all lands. People expected rates to fall back quite dramatically. This year it hasn't happened. We don't think it's very likely until probably the middle of next year before you get some rate relief. And to what extent, nobody absolutely knows. It's all a guessing game. All the best experts in the country thought it was happening this year and it hasn't happened, right?
True.
So no one absolutely has a crystal ball and can forecast these things. But a higher rate environment is ultimately problematic. We haven't seen those numbers come through in high unemployment or anything like that. We've seen some wages growth, and if wages continue to run hard, well, then over time, maybe you see the economy start to battle a little bit. And the valuations in credit for significant parts of the credit market are not that attractive for the risk that you're taking at the moment. So we're operating our portfolio almost with a barbell sort of style approach, which means that one end we've got these very attractive investments where we're providing capital to the non-bank lending sector that's growing really quickly. And that's a really attractive investment because not many people can do that type of funding. So we have a bit of a supply and demand dynamic playing out that's in our favour at this point in time. And at the opposite end of the spectrum, in the public markets, we've chosen to be quite conservative.
Okay. So, Chris, can you talk us about Alexander Fund's greatest strengths as a fund manager?
So I think there's a number. Don't know what the precise number is, but there's quite a few. And I think it's the number one thing stems from we manage client money the same way we manage our own. So there's significant alignment of interests. We manage it on the same terms and conditions and the same fee. So our money's in the funds and we manage it alongside our clients. The strategy itself reflects the beliefs and the origins of the principles behind the business. It's how they've always managed their own money in these markets. Now, Chris Black's been in credit markets for over 30 years. Adam's been in it for over 20 years. They're the two principal decision makers of how our money's invested on a day-to-day basis. Their money's invested in the funds alongside the clients. So I think that's a significant competitive advantage for us and aligns us really nicely with the end client. I think the other competitive advantage, or one of the things that differentiates us, is that we have this relative value strategy in the pursuit of positive nominal returns. And getting back to what I was saying earlier, that we are able to traverse the credit markets to identify and invest in the best possible value at any given point in time in the cycle. Credit has popularized quite a lot in the last sort of couple of years in Australia, and there's a lot of new strategies out there, but quite a lot are just single sleeve portfolios. They might just do corporate bonds, they might just do structured investments, they might just do a certain type of private credit. Our view is we need the skill set and the broad palette to paint with such that we can be in all of those things based on the best possible value available to us. I think our expertise in certain pockets of the private credit market is quite compelling as well.
Okay. So, Chris, can you talk us through a time when you've turned a period of poor returns into an investment opportunity and turned the performance around?
So the funds have always done incredibly well. COVID was a challenging period at the onset of COVID for us, and it hit quite quickly, but didn't last very long in terms of the impact on financial markets because of the amount of stimulus that governments around the world threw at the problem. So we experienced a very short period of negative returns in March 2020, a very small negative return in April 2020. And in the credit income fund, they're really the only negative returns the fund has had in its sort of 6-year history. I think we've had 4 or 5 negative months for the Credit Opportunities Fund in over over 12 years. So we haven't had it happen very often. During that period, we were able to control the risk of the strategy quite quickly and control what's the exposure to the market at that point in time, which protected us and our investors from significantly negative returns. When the fund was established, when the original fund was established, the Credit Opportunities Fund was established in 2009, that was really established out of the ashes of the global financial crisis at that point in time. So, but it says a lot about us as an organization in that we have the capacity, skill set, and mindset to be able to buy deeply depressed securities from a valuation perspective at that point in time. And to a large extent, that's how we are built as an organization. We are willing and able to be able to buy things at deep discounts when that opportunity prevails. And they're the two standout points in time over the last 15 years where it's represented substantial value. Now, for the most part, that's not the sort of return profile that you're looking to experience in credit markets. But from time to time, those exogenous shocks occur and it throws up the opportunity to buy things at deep discounts to what we would call very attractive value. And you have to have a willingness and a mindset to be able to take advantage of that when that opportunity prevails. And I guess a good example for clients or consumers, and they would do it in their normal day-to-day life, as I do when I go to the supermarket. If I go to the supermarket and I can buy 2 tubs of ice cream for $10 instead of buying one for 10, well, I'm buying 2. I'm going to stick both in the freezer, and I'm fairly happy because I know the ice cream is going to perform the way I expected it to perform. And I know it's good. I just know that for whatever reason, the seller at that point in time decided to put it on sale. So the same happens in share markets, the same happens in credit markets. Valuations can, at different points in time, provide you with tremendous opportunity, but you have to have done the work, have the skill set, have the ability to be able to buy them. And that's quite difficult for a lot of people to do. And in credit and fixed income markets, in some respects, that's the job that we do for people that they might not otherwise be able to do themselves. Okay. We also provide access to fixed income markets, particularly credit, are reasonably opaque markets. They're not easily accessible by consumers directly. So we fulfill a role for income producing portfolios that is not easily done by them in any other way. If I look at share markets, most people, if they really want to, they can go buy the Commonwealth Bank, they can go and buy the National Bank, they can buy BHP and Rio and whatever else they want to buy. In credit markets, it's not so simple. That's not really available to the consumer directly. There's no exchange that they can readily go and buy the sorts of things that we buy.
Sure. So talking about opportunities in the market, what type of investments have you recently made?
So getting back to what we were talking about before, there's been a substantial growth in the non-bank financial sector in Australia. Now that's grown for a whole bunch of reasons. One, the banks themselves, the major banks, have chosen to have a strong preference for AAA, perfect mum and dad mortgages where everybody's got a job, a perfect job and 2 incomes, and they can comfortably meet their payments. And that might be sort of a AAA ideal mortgage type scenario, and a lot of banks have preferred that. The Royal Commissions that the banks have been through in recent years have also impacted their ability to do certain types of lending. And that's resulted in a multi-billion-dollar funding hole that is now being fulfilled or filled up by the non-banks. Now, non-banks typically have a specialty or a niche. They might be small to medium enterprise lenders. They might be equipment finance lenders. They might be auto finance lenders or personal loan lenders. So they can come in all shapes and sizes. But the number one problem they have is that they're not banks. They don't have deposits. So therefore, they don't have a bundle of cash that they can just start lending to people. So they rely on the investment markets and fund managers like us to be able to provide them capital to on-lend to their clients. And we do these things in very specialized structures that give us significant protections and access to all of the underlying loans that they write. And that's the protections that we get. We obviously do a lot of work on the non-bank lender themselves in trying to understand their processes, their procedures, their approach to writing new loans and underwriting new loans, their approach to the management of arrears or defaults. So we do a lot of work with them. And then obviously we're determined to what extent we're prepared to provide them capital for them to be able to fund their business and their operations or provide loans to people. And that's a really attractive space because that's a really fast growing sector because of the things that we're talking about before. Technology innovations also helped the non-banks grow. But there aren't many managers that are able to do this type of work and are not specialists in the sector. And so that's enabling us to receive very attractive returns for the risk that we're taking.
Sure.
And as I said earlier, at the other end of the spectrum, we're choosing to invest in really high quality, short dated securities that give us a high level of certainty. The yields are not quite as attractive, but given the uncertainty that I think we still face economically and where valuations are at this point in time, we think it's a prudent way to manage the fund.
And that goes back to that barbell strategy you mentioned before.
Yeah, correct. And I think we've been in that situation really for a couple of years now. Like I think you would call us. I think fixed income managers and credit managers are notoriously negative. We often think the sky's falling on our heads. So I think that's the starting point because we're so concerned about risk. We're so concerned about loss. So we spend a lot of time being reasonably conservatively positioned or thinking conservatively about things. But when opportunity presents, you have to be willing to invest. And this non-bank sector is a really interesting space where we have some really strong competitive advantages that's yielding really, really good returns for the risk that we're taking. At the other end of the spectrum, we just think that it's worth being a little cautious at this point in time because the macro factors are still a little uncertain. Rates are still high and still likely to impact people into next year, and valuations are quite unattractive.
Sure, understand. So how do you stay up to date with changes in the financial markets?
Look, we, like others that participate in financial markets, all managers are very connected, obviously, to all the systems that are available to you and all the people that operate within the financial system. In our particular area, we think it's really important to stay connected to individuals, particularly in the credit markets where there's not this public exchange the way there is in the share market, and the information flows are not quite as readily available. So the credit markets are a little more opaque, the information flow is not as readily available. So therefore, you need to be connected to individuals across a whole range of different types of financial organizations to ensure that you deeply understand the things that are, one, available and two, investable. The private piece that we talked about before, funding of these non-banks is a great case or point in case where we spend a lot of time working with those groups, working with people that are connected to those groups so that you can continue to identify opportunities that may not otherwise be there. And a group like Alexander, one of our number one benefits to end investors is our access and the opportunities that we can create in a space that would be otherwise considered quite opaque to most investors.
Okay. So Chris, what makes a good portfolio manager?
So many things. I think alignment of interest is fundamental. I think that you want the people that are managing your money to be investing their money the same way and there to be some connection or belief in that that's the way in which you go about it. I think most fund managers have a high level of detail about them. They're not always the most social of creatures. They're not always the people that are on the TV spruiking their wares or promoting themselves. The best managers are quite often quite opposite. Because if you think about the amount of detail that they immerse themselves into understand an investment, they're spending 48 weeks, 60 hours a week, immersing themselves in detail. And most people are busy doing their jobs, whether it's a doctor, a lawyer, a plumber, or an electrician. And then looking after their families. So it's a unique person that is willing to immerse themselves in this level of detail on a day-to-day basis to understand an investment idea. So finding those people is important. Alignment of interest is quite critical. I think there's a couple of really good elements to individuals there.
So Chris, we've covered a lot of ground. Is there anything else you'd like to add?
Not particular. I think that credit is, apart from to say that I think that credit is probably not an area that's well understood in the broader markets and the broader consumer market. Ultimately, it's just a form of fixed income. And fixed income is just a promise from one person to another or one entity to another to pay back some debt. And I think that most people that I've ever met in my life have had exposure to debt in some way, shape or form. They've either borrowed money to buy a house, a car or something. So whilst on the surface of it, it might seem complicated, at its core, it's something that nearly everybody I know has had some exposure to personally. They've either lent money to someone or they've borrowed money from the bank or someone similar. And we are essentially doing that. We are either providing capital or providing a loan to someone with the hope that they pay it back, or a little bit more than hope. We hope we've done a lot of detailed work to make sure that they're good to pay it back and that they're going to pay us some interest along the way. Or alternatively, we're buying a loan that already existed between two parties. And so it's not complex. I think fund managers at times can overcomplicate what we do. But at its core, most people and people that invest in our funds, they're getting exposure to the interest and the coupon payments that come from loans. And if we can do that and provide them positive nominal returns through a variety of different types of market environment, such that they can achieve the things that they want to achieve, then I think we're doing our job.
Chris, I appreciate you making the time today.
Thanks, Joel.
If you'd like to talk to Solace Financial regarding your current financial strategy and whether it's suitable for your goals and objectives, please reach out and contact me via our website or give our office a call to schedule an appointment. Thanks again for your time today, Chris. I really enjoyed the conversation and I found your insights very informative.